Okay, good afternoon, everyone, and welcome to the second episode of this year's What Economists Really Do series. I'm Banu Demir. I'm a professor of economics in the economics department at Oxford. I'm also the associate head for external engagement and communications. So today's episode is a special one for us, as it is generously sponsored by the EBC Financial Group as part of their commitment to making economic research accessible to the public. And the title of today's episode is very much aligned with this commitment. It's going to be about thinking like an economist. I'm very delighted to introduce our main speaker today, Professor Michael McMahon. So from the economics department, of course, so Michael's a leading macroeconomist whose research spans monetary economics and fiscal policy, and he has written extensively on how central banks should communicate with the public. In today's talk, he will tell us why financial and economic literacy matter for us, and also will help us understand why even highly educated people sort of fail to make sense of economic policy and personal finance. After his presentation, Michael will be joined by David Barrett, CEO of ABC Financial Group, who will bring in an industry perspective and talk about how economic thinking translates into real-world decision-making based on his extensive experience in the financial sector. Okay, so before handing it over to Michael, let me tell you a little bit about the logistics. So Michael will speak for about 30 minutes. And then it will be the presentation will be followed by remarks from David, and then we will finish with around 15 minutes Q&A. So you can put your questions in the Q&A box using the Q&A function on Zoom during the talk. I'll try to group them by theme, and we'll try to cover as many questions as possible during the discussion. Okay, with that, I'll now hand it over to Michael.
Thanks very much, Banu. It's a pleasure to do this. I really do like these What Economists Really Do series. Of course, I've been involved in a few of them in the past, and I always feel like a caveat is required, because one reason we have this sort of program is because economics, not just we think, but our economic research in the department touches on all aspects of things that you would think economists work on, but also things that you probably didn't think they work on. So, for example, how people make decisions at home, how committees on deciding interest rates make decisions, but also about how different incentives in the economy might make people commit more crime or less crime or whatever. The caveat I have to add is that I am exactly your stereotypical economist. I do exactly the type of things you probably think they do. I think about interest rates, I think about taxes, I think about government spending. So far it hasn't meant I'm barred from taking part in this series, but we'll see. I guess one person when they saw this title asked me, do economists think? And I'm going to try and convince you, yes, we do. The other response that you often get when you tell people economists advice is, well, economists are all a bunch of, and then you stick in left or right, depending on your own personal persuasion. I always think that if we're upsetting both sides of the political divide, we're probably sort of somewhere in the middle doing something right. But there are people out there who'll be listening to this who think that we are in general a group of incredibly left-wing or incredibly right-wing. I'm not going to try and convince you either way today, but let's see what you think. Here's why I like economics. I think economics does teach a series of powerful concepts. And those are concepts that allow us or empower us to think about choices either that we make as individuals, or, in my research, I've often thought about why policymakers, either, in government or in central banks, why they make decisions. And, but like I say, that's one arena. Like I said, there's also this issue of, how do you make decisions in your home? How do you choose how many children to have, depending on tax incentives? All of these things are things we cover. And that's why we have this What Economists Really Do series. Again, it is not, and when I teach all the first year undergraduates here, I do not try to get them to think one way or the other about the world. What I want them to learn are these tools, these concepts. And that's sort of why I think, there's a value to thinking like an economist. Here's just to point out that not everybody does think like an economist. This is a series of charts that for a bunch of countries there, and what each chart shows is a scatter plot where each
Right.
dot is a particular monthly observation for expectations. And the X and the Y axis are the X is expected inflation and the Y is expected output growth. And this first set of pictures I'm showing you, and this comes from work by Olivier Cobillon and Yuri Gorodnichenko, shows that if you look across professional forecasters and you look at the same time periods, um, professional forecasters, in general, over this particular sample period, had this upward sloping sort of correlation between these two. So in general, they expect higher output growth to come with higher inflation and lower output growth to be associated with lower inflation. If we look at the same countries, the same time periods, but the only difference being the people asked for their expectations are households, you can see we get the exact opposite response. So the professionals tend to think these things are positively correlated and households tend to think they're negatively correlated. That is just one example of how our views on the economy between professional economists and households can be quite different. Again, I'm not at this moment telling you one is right or one is wrong, just that they are different. There's sort of three core elements to my talk today. There's a broader concept called financial literacy. There's a more related to economics called economic literacy. And I want to add in an idea that's developing some momentum behind it of this concept of fiscal literacy. So I will talk about each of these in turn, and then I'll sort of give you some highlights from my research and others' research that I've sort of taken away on these. Financial literacy here is defined by the OECD, but it's essentially whether you understand financial concepts. And so you can make decisions like how much to save, how much to invest. If you make an investment, do you understand the risks? So, these are, super important to everybody's life. You might say, Michael, you're thinking about who sets tax rates and how they set them. Yes, the
I
taxes
know.
influence me, but maybe I don't feel like I have
Now
any
it
power
came. I think it's just
to influence that. Um, on the other hand, if you think about your own personal finances, almost everybody in their life will take out a mortgage or will take some other debt product to pay for something. And how they make that decision, whether they make the right decisions on the interest rates or the products that they use, this can be super important and can massively impact their financial wealth, but also we know that has correlation to their own sort of mental health and their well-being. Just to be clear, not all economists have financial literacy. It's always a point of amusement between me and many of my colleagues that friends will ask us about our view on stock picks or whatever. And again, economists are not particularly trained to do this. Um, Economic literacy, I've taken this definition from a paper by Livermore and Major, an ability to apply economic skills and frameworks to explain or debate much of the world in which we live, from understanding opportunity costs in our personal decisions through to forming a view about the efficacy of economic policies. Like I say, I really hope all economists have at least basic amounts of economics literacy. But I think that sort of application of these concepts and ideas I referred to earlier is what we're sort of thinking about here. And then finally, there's this idea of fiscal literacy. Fiscal policy is when the government uses spending and taxation decisions and they influence the economy with those. We are in the UK about to build up to the budget later this month, and there's a lot of discussion already about it. And there's a question of whether the electorate, who rightly have the democratic responsibility to pick the government, whether they can, understand the complexity of the choices facing the government. Can they grasp the trade-offs involved in what decisions can be made and what are being made, and frankly, when you see some of the debates on fiscal policy, you really can see quite clearly how, you can easily breed distrust in government, foster misinformation when people don't have that type of understanding of the choices, the difficulties, and the trade-offs. So I'm going to talk a little bit about that. I'm going to start though with a sort of framework. I'm going to sort of cover two parts. I'll go to the fiscal one at the very end, but I'm going to start with something that I've talked about in much of my research, particularly with Andy Haldane and Alistair Macaulay, which is the 3 E's of public communication. These were written actually and explored initially for central banks, but again, they kind of apply more broadly to economics knowledge. So these 3 E's concepts are explanation. So in other words, can we actually, explain what we're doing in terms that people will understand? There's a term related to education. In other words, can people, because one of the messages that comes out is that some of what we talk about, the ideas are complex. Can people be educated to understand this? Now, there's interesting questions here. I'll come on to who's responsible. How do we do it? Do we do it at school? But again, I think education is a key part. And the last is engagement. And I was introduced recently at an event that I don't remember necessarily saying this, but apparently the key takeaway someone at a central bank had taken from my talk was that I pointed out that if a central bank is putting videos out on Instagram and people have a choice to instead watch cat videos, they're going to watch the cat videos every day. So there is this question of how do we build that interest and excitement in these topics or in these issues that massively affect people. And then, like I say, I'll come back to some of the fiscal challenges and fiscal literacy issues that are sort of a part of my ongoing research. So let's talk about explanation. Andy Haldane, actually, when he was at the Bank of England, sort of started a big push on this. And part of it is motivated by this score of knowledge. So if you look by socioeconomic class, there is quite a gap between how well people understand, in this case, the Bank of England, what it does, why it's setting interest rates. If you then also knock on, and I haven't included it in this chart, but you can also see that satisfaction with the central bank's performance is also related to this understanding. Again, correlated. What really was the sort of impetus for broader engagement by central banks was the fact that after the financial crisis, this satisfaction measure dropped a lot. There was a lot of discussion that, the banks had been bailed out and this was central banks doing, and that, we should be more critical of them. Within the economic classes, there's an element of things that could be done better, of course, but there's a lot of the actions that were taken prevented an absolute cataclysmic collapse in the economy, which itself would have been incredibly damaging for everyone. So getting that across, explaining that and understanding these differences became something that Andy became super interested in. And the need to communicate more broadly is sort of emphasized by this chart. Let's not talk too much about the particular measure that's plotted on the axis here, but over time you can see that these measures of reading grade level, these are essentially measures of how many years of education you need to understand different documents. If we start at the bottom, you can see, and this is from one of Andy's original sort of speeches on the topic, you can see that politicians' speeches at the time were accessible to people with 8 years of education. Now, that is very accessible. That's covering at least sort of 80 to 90% of the population. The Economist, a place that many of this interested audience might go for stories, is accessible. It's written at a level for 12 years of education. If you look at the Monetary Policy Committee minutes and the inflation report, they were at 13 and rising to 14, 15. And then the Federal Open Market Committee, which is the equivalent body setting interest rates in the United States and arguably the most important interest rate setting body in the world, they were operating at an 18 years. So that is to say, you are excluding most people from reading this stuff directly. Okay. Andy and I, in the sort of original paper in 2017, we sort of considered a number of reasons why we thought central banks should stop just talking to markets and should start talking more widely. We thought that, households make up in most countries something like 65 to 75% of all economic activity. So their beliefs and their understanding really matters. Nobel Prize winner Schiller has a book on narrative economics, and this is the idea that we need to get more stories across about economics. We have this correlation that says that confidence is related to trust and belief about credibility of the institution. And this is, of course, important when you have unelected officials in charge of an important macro policy instrument. We thought it could also help the media. You might say, look, nobody, Michael, goes to the Bank of England or the Fed website directly to get their information. That's true, but many people will go to media sources that rely on the Bank of England's explanations. And if the journalists or the people, the influencers posting on Twitter and TikTok and Instagram, if they can't understand it fully, then they won't be able to pass on the message. And finally, as part of an improvement of how the central bank makes decisions, I think it's important that the central bank also listens to public concerns, listens to what they're worried about, listens to where they think issues are developing, so that they can either explain how they're dealing with them or explain, what possible other options there are to deal with them. For example, fiscal policy is a much better tool than monetary policy to deal with issues of income inequality or poverty. Okay. What I guess is a bit unusual is this movement that comes from this work that looks at using an experimental approach. So again, this is nothing that different to what most of you will have done in your sort of secondary school, high school sciences, where you measure something. In these case, we do it with questions to establish some kind of baseline, what we would call the priors. And then we randomly assign treatment. So some people are randomly given something complex like the monetary policy summary, the traditional communication to read, and others are given new, carefully layered, written for a broader audience documents. And since they're randomly assigned, we can then, after we assess their views after treatment, we can then measure whether those that read the layered content had a different outcome to those that read the traditional material. And that's exactly what Andy and I did in this paper that we did it in 2017. It was published in 2018. Okay, I'm not going to go through this. This is of that sort of era, the standard kind of statement. The Bank of England's monetary policy sets monetary policy to meet the 2% inflation target and in a way that helps sustain growth and employment. At its meeting, ender, blah, blah, blah. Very boring. Most people don't get beyond the first paragraph. The bank created this layered content. So here's the equivalent layered content from November 2019. This is, of course, not what we experimented with, but they have this in a nutshell. Growth has slowed. Inflation is a little below our target. Brexit uncertainty has been high. If growth stays weak, interest rates could fall. If growth recovers as expected, rates may need to rise. And then it goes into a bit more detail. So the question was, if you see this sort of layered, easier to read content versus the harder stuff, do you get a different outcome? The answer is yes. The layered content is easier to read and understand. And this is true even for relatively advanced, technically advanced audiences. So not only did we do this on the general public, we also did it on some of our wonderful master's students in economics. And even when we look at what impact it has on understanding, it's equivalent in terms of the levels, the average level improvement, to the same effect of two identical people, but one having studied economics, the extra understanding that they would have. And that's just any economics as part of a degree. They're not economists necessarily. It also, importantly, tended to improve perceptions of the institution. So once you'd learned how they talk, you could understand what they're saying, people seem to express that they trusted them a bit more. And also it tended to shift their views potentially from thinking inflation and output would be negatively correlated to being more like the central bank thinks. Okay, so take away from that first sort of work in this area, simplifying communication can go a long way to achieving the central bank's aims of expectation management and trust building. Okay, but then there's a question of what complexity do you reduce? And this actually, the idea of this partly comes from, this is work joint with one of our current students in Oxford, Matthew Naylor. Um, and here we were trying to distinguish between what we might think of as the semantic complexity. So this is long sentences, big words, complex words, in terms of their makeup. And this is exactly what that measure I referred to earlier, the Flesch-Kincaid index, captures. This captures, are we using big sentences, lots of words in a sentence, etc. But actually, if you think about it, when you learn to read, you know, I've got three young kids, so I've been through this process. When they get something they don't understand, you put your thumb over it and ask them to read the first part and then break it up, do the second part. And that I discovered from talking to colleagues is actually common across many different languages. What's much more difficult is if you come across complex ideas that you've not seen before, technical terms, or just things you've never heard of. And so um, I remember this hitting home when at one point I tried to read my older sister's PhD thesis in nuclear physics. Now, I have many years of education, and yet to claim I learned that much from reading this sort of highly technical document would be massively overstating my own ability. It turns out it's not education that, it's not because the words were, sentences were long that I was struggling. It was really that the concepts were completely unfamiliar to me. So again, to do this, Matt and I ran an experiment with the public where we took the same documents but varied their complexity in terms of semantics and conceptual. And we show that actually it's the conceptual that really matters. The real issue is that economists talk about things that people don't understand or don't understand well. And again, this also helped even among people who studied economics at university. So there's a real takeaway I have from this, that yes, we can try to talk to a wider audience, but as long as we keep talking in our sort of working language with the concepts that other people don't understand, it's going to be problematic. And to me, this boils down to economists' willingness to trade off precision and accessibility. Accessibility means, if I use the term jobs and prices, people know what we're talking about, whereas economists would talk about, GDP and inflation. And again, these are related concepts, but they're not quite exactly jobs and prices. But we need to sort of to open the world to interested parties. We have to be a bit more willing to make that trade-off. So that's a lesson for us as economists. Let me talk about this second challenge, engagement. It's always been surprising and slightly sad to me that some of the most popular TV shows and documentaries are those that look at quite complex issues that probably don't affect people's day-to-day lives. Microorganisms at the bottom of the Mariana Trench, or, Brian Cox talking about black hole theory. I mean, these are super interesting, they're wonderful, and they grab your attention. Documentaries on economics are much less engaging, it seems to be, and much less produced as a result. So how do we as economists get people interested, excited, engaged about this thing that really does affect their day-to-day lives? And this was sort of stands out, when we did our first experiment, a third of people had never heard of the inflation report. And essentially, if you write the nicest things, you write them in a way that people understand, but nobody engages, then it's just falling on deaf ears. Whereas, if you engage and people don't understand, that might not be as bad. There's a lot of evidence that just engaging, even if people don't fully understand or fully buy into what you're saying, it helps to build relationships and maintain trust. And frankly, in today's day of sort of mass information overflow, if policymakers aren't talking to people, someone else will, and that's possibly with inaccurate messages. In the worst cases, inaccurate because they are trying to mislead. Okay, so we should worry about this. My favorite example of this is the Bank of Jamaica. I won't play the video because we're short on time, but if anyone's interested afterwards, go to YouTube and Google Bank of Jamaica inflation targeting videos, and you will see when they were announcing this new fully fledged inflation targeting strategy, they put together these wonderful music videos with reggae playing, emphasizing the low and stable inflation environment and trying to get people engaged. Okay. Now, I'm not sure the Fed is going to ask, Taylor Swift to do the press conferences from now on, but something like this has to be done to engage people. And just to say, this idea of engaging the public was always in the Bank of Jamaica's intention. So this is a document they published a number of years earlier, which were pamphlets that are apparently designed to enhance the public's understanding of key central banking issues. It turns out they just wrote it in very dry, boring ways that we economists tend to talk to each other. And so this clearly had failed on the engagement front, but the videos maybe were a better way to go. I'm not going to say I'm no social media expert, so I won't say too much more in the short time we have. Let me touch on then the education challenge, because here I do have a bit more to say and a bit more research. We know that better economic education tends to make people more engaged, tends to reduce how much they get surprised by decisions, and tends to be positively correlated with trust in governments, trust in central banks, trust in economists. But there's some interesting questions. Who should be responsible? Who teaches people what interest rates are? We've got a new announcement that we're going to have a big push on more financial and economic literacy in schools, which I think is a great thing, because it always surprised me. And there's nothing wrong with knowing how to calculate the volume of a sphere. But if you can leave school without knowing what a mortgage is or how to think about mortgages and their evolution of interest rates over time and what it means for your personal finances, I think that is a problem. And so this big challenge is, how do we help people to understand? Well, once the Federal Reserve Bank of New York tried to get people at a very young age. They created a series of comics that were explaining central banking to them. But in some recent work with Ryan Rolls and Peter Rickards, we've asked specifically how we can try to do this. Can we find out what people think of the world, and can we influence these, coordinate their beliefs? So if you think back to my chart at the start, can we get people from thinking the correlation is the opposite to economists to maybe thinking it's the same? Okay. To do this, it was a lesson time. So we basically did an experiment, but people were forced to watch an experimental teaching method that I will show you some pictures from. I won't show you the video. Some saw text, some saw video. Let me explain it. The basic idea of how economists think is captured for me in this chart. This is, you can think about each balloon. The blue balloon represents the demand side of the economy, and the orange represents the supply side. That means how able is the economy to produce the goods and services that are demanded. The key thing that economists think about is that these things are linked. And here they're linked by this sort of seesaw around that sort of middle dot fulcrum. What it says is that as the air goes up, let's say in this diagram on the demand side, there's more demand relative to supply. So the key with the seesaw is that it's the relative balance between these two that matters. And when there's more demand, we tend to think that inflation goes up above its sort of normal rates of 1.5% to 2% in most countries. Again, if you had the reverse, if supply was bigger, then you'd have downward pressure on inflation. And central banks are charged with trying to keep inflation around 2%. In many countries, we've seen the damaging impact that high inflation has. Then we explain to them how the interest rate can do that. And actually it works through adjusting the air in the balloon for demand. So if you raise the interest rates, then households want to save more and spend less, and businesses don't want to invest and hire so many people because the cost of loans and borrowing goes up. That means there's less household and business demand, less new jobs are created, and we get this demand more in line with supply. Okay, I'll show you this one picture from this particular intervention. The blue is how people thought in advance, and you can see this looks where unemployment and inflation are positively correlated. If instead, after they've seen our video, they now think they're negatively correlated, they actually swing to thinking like economists in terms of understanding how we think supply and demand tend to go together. They were asked, what if the government spends more money? What would happen to inflation and unemployment? Okay, so that's one particular understanding aspect. We also asked them if they understood what happens if you increase interest rates. And again, initially, about 73% get it right that if you increase interest rates, activity falls. But they're much more mixed on their understanding of inflation and unemployment. Um, After the intervention, we actually get them to the point, both immediately and when we follow up with them 20 weeks later. So we have not done any more intervention. We haven't taught them anything else. We show that they still think pretty close to economic expert samples that were taken in another paper, even 20 weeks after watching my little 5-minute video. If anyone's interested, the video is available on my website. I can attach it in the link to the YouTube. We also, can see that this is particularly large in effect if we look down here for people who watch the video. The text is the same words and it has a big effect, but you really see these two are the big one. If we just try to take the boring statements and make them a little bit more descriptive, that has some effect, but not as much. Okay, so there's a real effect of targeting our educational treatments. So we take away from this, people have learned more than we expect and we can improve understanding. I've got about 3 minutes left, so let me quickly finish up. But let me just show you one thing. I think this is another lesson for economists. We asked people in this experiment about what would happen, how would policy respond if inflation went up and unemployment went down. We tell them it's unexpected, and we asked them, this is with an American sample, we asked them how the Fed, in the UK it would be the Bank of England, would set interest rates. Here's the responses we get. About 2/3 initially get it right. They know that if the economy is getting hotter, rates will go up. If the economy is getting weaker, rates will go down. There's a little bit of asymmetry between increase and decrease here, but in general, they get it right. We improve it slightly, and they continue to be sort of knowledgeable years out. But this is a really good understanding of the basic response of monetary policy to the economy. We then show them an actual Federal Open Market Committee, the MPC equivalent in the US. We show them an actual statement, but we remove the decision and we ask them. Now, remember, these are people who know, with our simple example, they know approximately what the directional change is, and we ask them for a directional change. Here are the responses. Hypothetically, about 2/3 of them get it right. Random guessing, given there's 3 options, would be 1/3 getting them right. When they read what the central bank writes, they get worse than random guessing. Like, this is a damning indictment of how we write things for an audience that in theory has some idea of what's going on, but just can't get through central bank speak. Okay, let me finish last minute or so on fiscal issues. There's a few interesting ones here. And again, as we approach the budget, fiscal literacy's jumped in my head a lot. I should say I've served for quite a long time on Ireland's Fiscal Council, the equivalent of the OBR. This is not reflecting their views. These are my own. But look, why is fiscal communication harder? Well, one is people very reasonably have their own preferences about how the system should work. You can have views that you think there should be a lot of government supports or little government supports. You should have views of we should have lots of government supports funded by this group paying or this group paying. That's not what I'm here to think about. There are plenty of people who do that, but that's not it. Another issue is, though, that understanding of the issues does tend to be quite low. There's this work by Tax Policy Associates that asked people, if you're at the limit for the basic rate, which is 50,270, and you say, okay, you get an extra £1, which means you're now in the 40% bracket, how much extra income tax do you pay? Well, the reality is you pay the 40% on every marginal pound. So that extra £1 is taxed at 40%, but the stuff before is still taxed at 20% or not taxed at all with your tax-free allowance. And yet about half of people, and this is not along political lines, around half of people think that you will pay a lot more tax. Okay, that's a problem for understanding. Also, the numbers are big and those are not well understood. So, if the government spends 2.6 million on biscuits in a given year, that's not a fact. I'm just making that up as an example. How does this compare to a hospital bill that has an overrun of 1.2 billion? How do we compare 1 million versus 1 billion? Okay. Well, the way I like to talk to people about this is in seconds. So 1 million seconds. So if you were told you have to go to jail for 1 million seconds, you'd be in jail for just over 11 days. If you were told you had to go for 1 billion seconds, that's 31.7 years. So when people say millions and billions, there's a huge difference between them. And just for context, the UK government spending is approximately 1.25 trillion. In years, that is converted to seconds, from seconds into time, that is 31,000 years. Okay. So when you hear of spending of an extra million or an extra 2 million here or there, it's not to say it's right or we should ignore it, but these are very small numbers in the big picture. And I also thought I'd mention it because I've had a lot of emails today because of this social media posting, which I did for the university, pointing out some of the sort of basic fiscal arithmetic points. We can talk about them in the Q&A, but the question I asked was, what do you think raises more revenue? Adding 1 percentage point to the basic rate of tax, that's going from 20 to 21, or the higher rate going from 40 to 41, or take the additional rate that kicks in for the very highest earners and going from 45 to 46%. What do you think? Just in your head, do you think which one's going to raise the most money? Well, the answer is by far and away the basic rate of tax, because that's paid by the broadest amount of people in the distribution, including all of the highest earners will have to pay that on everything between the bands. So the numbers from the government's own estimates are about 7 billion versus 1.6 versus 145 million. If you want to raise meaningful sums in the budget, you have to adjust taxes that most people actually pay. You need a broad base. This doesn't rule out spending cuts or other tax changes, but any decisions, and when we see decisions made in Rachel Reeves' budget coming up, let's have that fiscal reality in mind. I will stop there. I think some of the lessons are we should think like economists. We should push this. But as economists, the lesson should be we need to make it possible, easy for these people to actually engage by communicating in a better way. I'll stop.
Thank you very much, Michael. This was a lot of fun, and I have to tell you, there are some interesting, challenging questions in the Q&A box already, and we're waiting for more questions. And before that, we will hear from David. So whether or how we should teach people, or somebody should teach people how to think like an economist.
Thank you, Banu. Thank you, Michael, as well. It's good to be back. I think probably I should start off with an apology, which is what I did the last time I was with you guys when we did the panel in the university. Unfortunately, I've been working in the market for about 40 years now, and I really believe that we are an intrinsic part of the problem. So I apologize for being part of that problem before I tell you what I think goes on. Markets generally have a really, really poor track record with educating and helping their clients understand what's going on. I think that's primarily because for many participants that are providing the product, the motivation is very poor. You can look at it on various levels. You can look at it as an institutional client. So to me, the poster boy of how to ruin a really good idea and not follow through with the concept of how it was originally produced is ESG investing. I mean, the market completely hijacked it. And I think that people's level of understanding of what they ended up buying was very poor. The other end of that is the retail side of the market, which for a company like EBC is a big part of what we do. I'm actually in charge of a UK firm, and we only deal with what we call professional clients, but a wider group that we're a part of is predominantly retail clients. And I think it's really interesting to note that 75% of all retail clients lose money. And the FCA actually makes retail brokers put that on their website to try and remind everybody that what they're doing does have risks. But I'm not sure that even on that level, people understand a lot about what they're getting into. Retail has a lot more complaints, and retail is much more vulnerable to that kind of exploitation that Michael hinted at in his speech as well. I think people engage with financial markets for different reasons, and the engagement levels and the understanding between the different layers of people that we're talking about is stark. If you look at the top of the stack, what we would call institutional or professional clients, the understanding of what they're doing and their interpretation of the data and information around them is usually very strong, although again I would take Michael's point that not everybody that pretends to understand this stuff understands quite as much as they'd like to think they are. And a lot of what I wanted to say is not really geared about the professional. They're not really a part of the conversation I wanted to have, because they tend to be a little bit higher up the curve. There's a bit in the middle, which I would call passive investors. Actually had a conversation with some friends this morning about it, and that passive investor level is growing. I'm not sure it's better informed, and I suspect one of the reasons why it's growing so strongly is that the market performance, stock markets tend to be the main focus of people's attention. I think that market performance has been so strong that it's masked a lot of the reasons why it's been so strong. And people have gone into passive investing because they've seen it as an easy way of jumping on that wagon. And they've done very well. I mean, there's absolutely no doubt about it that passive long only type funds have done incredibly well within the market that we're seeing. But the real victims for me are the retail victims. And I think if you look at the points that Michael raised, these are the people that I think are exploited by many people within the market. And I think they're also people that would benefit more than anybody else to try and understand, or to be educated in a more positive way about what they're doing, why they're doing it, and the potential impact of what they're doing as well. I think the biggest problem in our market is that they're missold many, many more times than they're properly sold. Many of them come through introducing agencies, many of them come through influencers, although it's quite interesting that the FCA has recently actually taken some influencers to court for misleading investors. So these are people that are trying to sell expertise that they have absolutely none of, because they have that social media profile, because they have a link via social media and other medias where they can interact with these people. Many people just take it as given. And the other thing I would say is there's many bad actors in the retail space as well. So really, education that's there to be had is very, very important. It's a bit of a cliche. All brokers that do what we do for a living will tell you that they're very big on education. They're very big on making sure that their clients understand. I think that's true and not true. I think if you look at the brokers and the bank's motivation for engaging with you, their motivation is that they want to make money. And that's not necessarily always aligned with what the investor or the client is there for, and their understanding of what they're getting. So I think a lot of the education that you see, particularly in our sphere, is done as more as a regulatory tick or as a marketing tick than it is actually trying to help people understand. And I think it's very difficult, right? You have to pitch things at the correct level. And the problem with educating the public is, and I think Michael's slides about the amount of time that you need to invest to be able to understand the different messages that are coming out from different institutions is very true. I mean, we can bifurcate clients into different categories, but you also need to bifurcate within that category as well. And the regulators got better over the past couple of years of making people that they regulate, companies they regulate, understand more about what their clients' motivations are and why they're doing what they're doing, and whether it's appropriate for you to sell things to them. So the FCA call it consumer duty. And I think that, again, is their way of trying to push people that are selling products to make sure, one, that it's suitable, but two, that people understand. And I think, one of the problems that we have is that we tend to have this huge density of jargon that we throw at people, and we expect them to understand it. And it's really not true. I think there's a complete lack of engagement with real world concepts. So again, Michael mentioned about the government's come up with a scheme from 2028 where they're going to start to educate at a much younger level about household budgets and mortgages and so on. And I think using those real world concepts is very important to how you engage with your clients. One of the big problems we have as an industry is that we can put out a huge forest of information for clients to read, but many of them just don't read it. And I think that comes back to Michael's point about the layering. I think that the concept of making it more easy for them to interpret in a real world circumstance and trying to give them a much simpler brief of what you're trying to talk to them about is much more helpful. I genuinely believe people want help, and I genuinely believe that people wish to understand more. I think there is, as I mentioned at the beginning of the conversation, there's perhaps a bit of a dichotomy of motivation for institutions to give that to their clients. But I do think people want to understand. Now, the reason they want to understand is different for different people. Some people are there because they want to be rich and go and buy a nice new car. Some people are there because they want to look after their pension fund. Some people are there because they find it intellectually stimulating to understand it. And pitching that at the right level means that you do have to bifurcate your message to these people. And I think the inherent problem is that the real understanding of the incentive of why they want to be there is often overlooked. And the problem for the market is it's driven by lowest common denominator. I mean, for us at EBC, we have a big education part that we push to clients, and we do that regionally, and we do it by client group as well, because we understand, or we think we understand, that different clients require different things. But I think the incentive for a lot of people is to show something shiny and to draw people into things that maybe they are under educated about and they don't understand the concepts of it. And I think that's very dangerous for all types of clients, but particularly for retail clients. So you could ask, what are the solutions? I think incentives really matter. Why people are there, why they're trying to understand what they want to understand, or why they don't want to understand it and they just want to get involved. And I think it's very important that people really understand things from a real world logical point of view. So household logic, I think, is a great way of using that assimilation. Michael's example with the balloons, I've often done it with scales, which is basically the same idea. And if you adjust one scale, what does it do to the other side? But using real examples, real life examples, and maybe trying to interpret official messaging that comes into what it really means to people on the ground is a good way of doing it. I think fiscal policy and even financial literacy, it really needs to come to the client rather than expecting the client to come to it. I think it's important that central banks, governments, politicians, and people within the financial markets are better at explaining why people should understand, not lecturing to them about what they should understand, but why they should want to understand that. That sort of theory to reality thing, I think, is a really important thing. And the other thing I would say is, I think the world in general is appalling at starting early enough. I mean, I just don't think you can start early enough. I think we should do a lot more education at a much earlier stage. And I think that education should start basic and should build as people go through their education curve. So that even, Mr. Joe Sixpack on the street should be leaving his education cycle with a pretty good understanding of how the world works. And I think we've done an appalling job historically of making that happen. I think central banks have tried, and I think politicians have tried to an extent, but Michael mentioned the budget that's coming up. And if you look at the level of complexity of whack-a-mole that's going to go on with, we're going to do this over here, but it's going to affect this over here, and the big picture is going to mean this, it's going to be one of the big problems that the government's going to have, I think, is more about how they communicate. And as Michael said, the ability to communicate that in a way that's relevant to the people that are listening to it. So I do make apologies because I think the market does it badly, but I do think that we have a responsibility, and as a company, we try to do that. but I think it should be an intrinsic part of what the financial services industry does for its clients and the people that it's looking after. It needs to be much more engaged at all the levels rather than just throwing something out there and expecting people to read it and understand it. So the concept of education on of economics or financial literacy, I think, is a really big one, and I think it's really important.
Very much, David. Shall we move to the questions? There are some interesting ones. So as I said, we just group them by theme. Okay, Michael asked for it. So there's a Taylor Swift question, of course. But before that, I think the questions are about two things. So one is how to increase interest and engagement with economic issues. And then the second one is about education. So educating the public about economic concepts. And so there's a couple of questions about, okay, so who should do it? Is it the private sector, schools, the government? So where should it start? When should it start? And who should do it? And there's also another aspect to it, which is does the private sector or the government or policymaker have really the incentive to do this, or is there a way that they are just benefiting from misinformed or less educated public on economic issues? I know it's a long question because I'm trying to just combine things, but yes, Michael, David, who wants to take it first?
I'll go first. I'll just to say there's one answer that is very dull, which is, we shouldn't just rely on one entity to deliver education. I mean, there are interesting challenges. So for instance, if we start it with the very young, there's an argument, yes, we get them set up and then, they're fine. They can then pick up these pamphlets that virtual pamphlets that have to come with every mortgage product, investment product, or whatever. The problem is engagement at that age, so people start to think about mortgages when they start to buy a house. That's just the reality of our lives. We have other things interesting us until then. So I think the answer is we need a sort of broad approach to it. We need to give people the skills to be able to indulge in this information when they need it. And for some people, that might be at 22 or 23. For others, they won't start thinking it until they're in their 30s. And so I think we need lots of people doing it. I'm certain that people have incentives to misappropriate messaging in order, to make you think that the other side is doing something wrong. And really, one of the strongest advantages of education broadly is allowing you to make your own mind up. So for instance, let me just say it because it came in. If any of you watched the social media post that the university put out, that was me talking about some of the stuff I talked about. I have gotten lots of messages saying, why aren't you thinking about taxing the ultra rich? Let me just give a very quick answer to that. But there's a lot of political people who go around saying this is the solution and make it sound like economics or whoever are saying no, they're just ruling that out because they're ganging up against another set in society. It's not at all, right? There's very few countries that have implemented a large scale wealth tax that is easy to manage and raises significant sums of money. Even if you could implement it, if you did to do so would take years because we do not currently know what people's wealth is. To tax something, you have to measure it. To measure it would take us years. Even with that, would we then want to include everybody's private residence and farmland? In most countries, they get excluded and thereby excludes most of the wealth in the country. Again, very inconvenient facts. But you can look at places like Spain. The socialist government in Spain implemented one and then took it back after a couple of years because it just wasn't working. It's a hard, like, everybody likes the idea that someone else can pay or someone else faces the tax cuts or the spending cuts. That's just not the reality. But it's not for me as an economist to say which one you should feel like you like or don't like. But the reality is that we already have the top 10% of income distribution pay 60% of the tax, the top 1% pay 30%. Okay. So we are already in a system that, as economists, we would say this is a progressive system. We are taxing those who earn more at higher rates. Is it progressive enough? That's a political choice. So I want to touch on a question that you didn't throw in, but I thought it was interesting. Should we have a test to be allowed vote? Right? That
I was going to ask it next,
okay,
but yeah,
sorry.
go for it. No, go for it.
That's screamed out as it's almost like the old senates in many countries where you had to be educated to be in the Senate to sort of stop the plebites from, as much as it is difficult dealing with misinformation and, views that are based on wrong knowledge or wrong facts. The reality is democracy requires, and I'm going to, it's always nice to be able to quote Winston Churchill, democracy is the worst form of government apart from all the others. We are in a democratic society. As a society, we have to decide to do this, to pay for these things, and we have to figure out a way to do it. So for me, the answer is education. And Taylor Swift, if she wants to collaborate with me, I'm very happy to. Let me just put it out there. I think while I would be excited, I'm sure my teenage daughter would be particularly excited about that collab, I believe is what the young people say. But yeah, the answer is broadly, we need to do it at all levels. But my frustration, and again, it's sort of at the level of apology that David had, is that I don't think economists have made this easy for people, and we have to be accessible, and you have to put yourself out there, and when you put messages like this out there, you have to accept some people are not going to like hearing it, but you can just engage on a human level and explain why you believe that. So that's a very multifaceted answer, but I got to talk about Taylor Swift, and like I say, if her agent wants to get in touch, my email's on the website.
So we will put that in the recording for sure. It's not going to be edited, Michael. David.
Yeah, I would agree with pretty much everything there. On the taxing the high wealth, I think the other thing people need to understand is that the transition of cash, the way it can move these days, has transformed significantly. So if you look a couple of years ago, some of the regional banks in the States had cash runs, and it was mainly because big depositors that were getting incentives to deposit with them had a phone and they could pick it up, go onto their banking app, and they basically wiped out the deposits of regional banks. So if you're thinking about taxing people that have wealth, remember that wealth is very transferable and it can move very quickly. The other thing I would say is about the government and so on. I'm not casting any kind of political message here, but I don't actually think it matters who would be in government at the moment, whether it would be Labour, Conservative, Reform, or anybody else. The same problems that the Labour government have got to confront in the budget coming up would be there anyway, because for the last 3 or 4 decades, we've managed to get through with popular politics basically giving people what they want. And because they're not educated to understand the cause and effect of that, the reason we have a lot of the problems that we have now is not because they've just appeared, they've been fostering and festering themselves for the last 3 or 4 decades. And what we are forced to confront now, and I'm not sure we're ready to do so, are the realities of the decisions that we've been making, very poorly informed decisions by voters, politicians, and governments over the past 3 or 4 decades. I don't think it's any lack of correlation that the lack of understanding of the cause and effect of decisions 10 or 20 years ago do affect what we're seeing now. And people need to take that bullet and understand it, because that's the reality, I think.
I'll add one last thing. And so just to be clear, I think there's one tax on wealth or on a form of wealth that economists really quite like, and I don't have time to go into it fully, but that's a land value tax.
Yeah.
So if we wanted a proper reform of the tax system, get rid of the weird mess that is council tax based on 1990s valuations, a land value tax, it could be a wonderful change to the tax system, improve revenue and reduce burden, just in a way that is fairer, better, doesn't have disincentives. It would be fantastic. The other thing, just to pick up on what David was saying there, I actually think that for politicians, this part of the problem is that people have become used to this. You give us what we want, and anything else is seen as an affront. And, you know, as a result, they are incentivized as politicians to do it, because if it comes off, great. If it doesn't, you lose the election. We flip-flop to another 5 years of different policies, but you've left your opposition come into a world that's worse again than, you know, the last one went in at. We need to change it, and the best way to do that is from the public being informed and surrounding politicians to make sensible intergenerational decisions, which we can all disagree on exactly how they look, but then democracy will sort that out, hopefully.
100% agree. 100%.
Okay, I think we're on time. And first, I would like to thank both Michael and David for an amazing episode. So it's been very popular, as you can see. So almost 200 people stayed until the end. They asked questions and everything. So let me say that the recording, as for other episodes, will be available online. So you can watch it anytime. And thank you very much both. And thanks everyone for joining us today. Bye-bye.
Thank you.
Thanks, everyone.